Market structure is one of the most key components of trading. I believe how ICT and smart money concept traders look at market structure is one of the best ways of dissecting a marketplace through the teachings of liquidity, strong highs, strong lows, as well as algorithmic theory. But like many ICT traders, you probably get overwhelmed with all the information and can't yet piece it all together. Don't worry, I got your back, and in this video, I'm going to break down market structure into a simple process that's really going to revolutionize your trading. Before we get into the video, make sure you guys are following me on Instagram. Lots of free education on the market maker model, as well as this is where you guys can reach me if you guys have any questions or want to talk to me direct. So we all understand the concept of uptrend in a downtrend market, with an uptrend market making higher lows, higher highs, higher lows, higher highs. Pretty simple. Downtrend market making lower highs, lower lows, lower highs, lower lows, right? Simple as well. But let's go even deeper. Inside of this uptrend and downtrend, it's complied of these three metrics. As we can see here in this depiction, a swing high is classified as when the middle wick is higher than the previous wick and the next wick. So this middle wick being higher than the one to its left and its right would classify this as a swing high. And for a swing low, the middle wick being lower than the previous wick and the next wick would then classify this as a swing low. These would be your short-term highs and lows. Next, an intermediate-term high would be classified as a swing high or a swing low with two previous short-term swing highs and swing lows. As you can see in this depiction, we have this swing high point with two swing high points to its left and to its right. So the middle part up here would then be classified as our intermediate-term high, as well as an intermediate-term high can also be a swing high or swing low that has tapped into an inefficiency. So you can see price action has came up into this bearish fair value gap and then left it. This would then be classified as an intermediate term high. We'll talk about this more later. So last but not least, we have the long-term highs and lows, which in this depiction, we have this long-term high, which has these two intermediate term highs to the left and to its right. And inside of those intermediate term highs, we have these short term highs. As you can see, intermediate term high, short term highs. This middle part, this highest high here, would then classify it as our long term high. So to make this even more simplistic, let's classify intermediate term highs and lows and long term highs and lows as strong highs and strong lows. And let's classify short-term highs or lows as weak highs and weak lows. Let's get into the backtest and raw examples of this in action. When framing my market structure, I like to be on the 1 hour time frame. This gives me the highest probability swing highs and swing low points inside of the marketplace. So we can clearly identify that we've had this massive imbalance to the downside and we've came up into this imbalance, filled in the imbalance, and then we came lower. Remember what we said in the depiction. When we have an imbalance and we come back up into it and then leave it, that then classifies as an intermediate term high. So this would then be classified as our strong high, meaning price should not take out this high point. So when we're entering the marketplace and we're choosing which liquidity pool that we want to seek, either a buy side or sell side liquidity, we have to understand where is the weakest link inside of the marketplace. We clearly see we have strong highs above us. We clearly see that we've been inside of a downtrend marketplace. So this gives me better odds than not that the weakest link inside of the marketplace would be then sell side liquidity. Meaning this would then be classified as a weak low because we have strong highs above us inside of this downtrend. Next, we can classify another intermediate term high. Can you guys guess which one it would be? Be this because we have this swing high and then this swing high to the left and to its right. So this would then be classified as our another intermediate term high. So coming into the marketplace this morning, as the market comes up into this level, there should be a lower time frame order block inside of this range, which I would then like to get short at. Stop loss above this swing high, targeting this sell side liquidity. And this is what I would then look for when coming inside of the marketplace. So as we can see here on the 1 minute time frame, we have this last up close candles. Let me mark this out just like so and extend it. Now coming into the M15 time frame, we've identified the two intermediate term highs as strong high points, and we went down to the M1 time frame to then look at this M1 bearish order block. So as the market opens up, I'd like to get short inside of this bearish order block, stop loss above this high, targeting this sell side liquidity pool, because we understand that the sell side is the weakest link and these high points should now be respected. Let's see what happens. We open up, price taps up into our entry, and then take profit is hit down into sell side liquidity, just like so. Coming back on the H1 time frame, see where the marketplace stopped here. We took out this short-term low, but we didn't even get near this intermediate term low. As you can see, this would classify as an intermediate term low because we have this short-term low to the right of it and then this short-term low to the left of it. And as you can see here, the marketplace came lower, took out this short-term low, but didn't even tap into this intermediate term low before then reversing higher. Now coming into the marketplace this day, we had CPI. We have these two swing high points, this intermediate term high, and now we can classify this as a long-term high because this was the high that had this intermediate term high to the right of it and these intermediate highs to the left of it. So this is now our long-term high. So if the marketplace can see higher prices, it would probably take out this high, but we're still trusting that this long-term high remains intact because this would classify us as our long-term high. And let's see what happens. Marketplace comes up, it takes out this high, but it leaves the long-term high intact, just like we anticipated. Now coming into the next day, we can see here that we have this intermediate term high, that long-term high, and now we have another intermediate term high right here. Why is this an intermediate term high? Because this is the high that came up into this bearish fair value gap before then giving that rejection to the downside. So we could classify this coming into the marketplace as a strong high. And if we can go down into a lower time frame here and identify a bearish order block, I would then choose this as a level of resistance to then get short inside of the marketplace, targeting back below these lows as sell side liquidity, continuing that trend to the downside. So market's about to open here. We come up into that bearish order block. I would then take a short inside of this bearish order block, stop loss above that swing high, targeting back below these lows, continuing that trend to the downside because we understand this is a strong high. The weakest link inside of the marketplace is these short-term lows. So we're going to want to see the marketplace reach lower prices, continuing that bearish trend to the downside. And we can clearly see that we did not come back up into the strong high. Instead, we found rejection inside of this bearish order block, continuing that move to the downside. So coming into the next day here, we have seen the previous day come up into that bearish order block level. We had that strong high. It did not reach up into that strong high. Instead, found rejection that didn't take out these weak lows, right? And then come into the overnight session here, we can clearly see that we had this intermediate term high here. Price came up into, looks like a lower time frame order block inside of these long wicks here, failed to take out this intermediate term high before then seeing that drop to the downside. So coming into the marketplace this morning, I understand that we have now created a high and the weakest link would then be these previous daily lows. So any form of retracement that we get inside of the marketplace this morning, I would then be looking for lows targeting the sell side liquidity because I understand we've been in a bearish trend. We have strong highs above us and we have weak lows below us. I'm going to then capitalize and taking out on those weak lows. So my job as a trader now from a analysis standpoint is complete. Now it's time to execute inside of the marketplace on the lower time frames, targeting this sell side liquidity. So coming into the M15 time frame here, we can clearly see that we have this bearish fair value gap. I'm going to take a short inside of this bearish fair value gap, stop loss just above that high here, targeting these lows here for about a 2 to 1 R. And this would then be my trade idea for the day. And as you can see here, smooth as butter, we come back up into that bearish fair value gap and then drop to the downside. The high here that comes up into this bearish fair value gap is now classified as an intermediate term high. And let's just say we missed out on this trade. If we can get some type of pullback here into this bearish fair value gap, then I'd want to take a short here, stop loss up here, right? Targeting back down here for about a 1-to-1, maybe a 1-to-2. Just say we missed out on this trade and we had an opportunity right here. Let's see if this trade would then play out with this intermediate term high above us. We come back up into that bearish fair value gap, and just like so, price action did not break above this bearish fair value gap. It did not even come back up here into this intermediate term high. It came back up into a fair value gap, stopped, and then dropped lower, taking out this weak low, this short-term low point. Between this intermediate term high and this swing low, which one do you think is the marketplace most likely going to want to take out? This short-term low, because it is the weakest link. So when coming inside of the marketplace, it's identifying where is the strong points and where is the weak points, and then targeting those weak points inside of the marketplace. And then your job as a trader when coming into the marketplace and when executing is to anticipate that retracement, targeting those weak points. And I give you guys many examples here, very simple examples of order blocks as well as fair value gaps as retracement levels inside of the marketplace for you then to target those weak points and continue the overall market structure. So that's gonna be it for the video. I hope you guys learned a lot from this video. Maybe rewatch it a couple times to really soak up all the information that I gave you, as well as hit that like, subscribe, and comment any questions you guys have or what you guys want to see next. I'm Arkham. Be safe. I have released my private mentorship where I give daily lessons on technical analysis, fundamental analysis, psychology, risk management, as well as live trading and much more for your trading success. If that's something you guys wish to check out and want even more content and gems from me, not shared anywhere else, it will be the first link in the description or the first link in my Instagram bio if you wish to follow me on there as well, at Arkhamtrades. Thank you for watching.